Hi, good evening. Welcome to our today's special episode. We have a new fund being launched today by Samco Mutual Fund. I'm Karthik here. I'm going to be the host for today's event. So to take us through the fund and the details about the AMC itself, we have Mr. Jimeet Modi. Jimeet Modi is the director of Samco Asset Management Private Limited. An interesting fact about Mr. Modi is he's a rank holder in a chartered accountant examination, All India 9th rank, and he's the founder and the CEO of Samco Group. Under his leadership, Samco operates under a wide range of financial services business, be it in equity and commodity broking, depository services, equity research, mutual fund research, and distribution. He has his career spanning over 15 plus years with rich experience in equity research, investment analysis, and technology. He's a new gen entrepreneur. He's been recognized as one of the most promising entrepreneurs in India by Economic Times. So, welcome, Jimeet. Would love to hear from you more about the fund house and the fund, the Flexicap fund, which is being launched by Samco Mutual Fund. Welcome.
Thank you so much, Karthik. Thank you so much for the kind introduction, and big thank you for all the participants for taking the time out and attending today's session. What I will just quickly do is I'll share my screen. Yeah, so I'm hoping you can see my screen.
Yeah, screen is visible.
Perfect. So thanks. So basically, I think to just set the agenda of the presentation, what we will do is that I'll quickly give you a brief about the group as a whole. What our history has typically been. How we've gotten here. What the investment process of the fund is. What the strategy of the fund is, and then finally, just quickly do a recap as to how we are very different from the rest of the funds that are available on offer today. So just by way of a brief background, the group was founded in 1993 by Sri Mr. Vipul Modi as the Samruddhi Group. We rebranded it from Samruddhi to Samco in 2015. So Samco typically is the new age avatar of the business. And so as a group, we've been around for about 28, 29 years. With the brand Samco, we've been around for about 7 odd years. Naturally, because this is a mutual fund presentation, it can't begin without a disclaimer. So I'd like to make sure that we've completed that as a compliance obligation, where we've informed that the investment is obviously subject to market risks, and we'd like people to read all the other scheme related scheme documents carefully. Now, as far as our journey is concerned, 2018 is when we applied to SEBI to be, our sponsor entity is Samco Securities, and we applied in June 2018. We got in principal approval in 2019, got the final approval in 21, and here we are. We've launched our first scheme, which is the Samco Flexicap fund. It was launched, so the NFO was launched yesterday, and the NFO will close on the 31st of January. As far as just the governance structure of the board is concerned, what we've tried to do is sort of set up a fairly strong board in place. So we have Mr. G.N. Bajpai, who's the former chairman of SEBI, former chairman of LIC, who's the chairman of Samco Mutual Fund. Mr. Prabhat Kumar, who's a former cabinet secretary, who's the first governor of Jharkhand. He's another director. Mr. Sailesh Gedia, who's a chartered accountant, and Mr. Vipul Modi, who's the chairman of the group. So collectively as a group, the trustee company board members have experience of over 100 plus years. And on the AMC side, again, we've got a very, very rich pedigree of board members. So Mr. Ashok Kakkar, who's the former ED of SEBI, is the chairman of the board. Mr. Ishwar Nayak, a senior chartered accountant. Mr. Kanu Doshi, in fact, he comes with a very rich AMC experience. He was the former chairman of Nippon AMC, Motilal AMC, and Edelweiss AMC, and myself. So the idea of putting a strong governance structure in place was to make sure that the investors' interests are put first and foremost, and there is a strong governing board to look at these businesses and to oversee the operations of the mutual fund. Now, from an AMC point of view, what our core investment process is? So we call ourselves the stress tested mutual fund. So it's a new concept of investing. It's a new way of investing that we are introducing for retail and HLI investors in India. And the concept is typically very famous in the banking and regulatory parlance. So, banking regulators actually put banks through a variety of stress tests to evaluate if a bank would be solvent across scenarios. If at all there was let's say, an economic downturn, or there were any external shocks, would a bank still have enough capital adequacy, and would it be in a position to meet depositor obligations or not? And similar concept we are applying to the world of investing. So what we are trying to do is we've created a 6-faceted framework that we call the HexaShield framework, where we are running a variety of stress tests and scenario analysis for across every listed company in the world. And the idea is two things, right? First, we're trying to evaluate whether a business can survive in stressful situations, because I think that is the first and foremost most important thing. For a business to be able to make money for us as shareholders, it has to survive first. And because of constant disruptions in the world, the lives of companies have typically become shorter, and therefore these stress tests become critically important. And second aspect is, I think there is, over the long term, there is only one thing that really matters here. So which is, can our business generate an above average return on capital employed or not? So I think that is something that is extremely critical. Very often we take eyes of the prize, we by looking at silly things like just the PE multiple or EPS or PAT or so on and so forth. I mean, they are important from a shorter term point of view, but over the long term, I think the business, whatever the business makes in terms of the return on capital employed, is what is going to be the stock price CAGR. So we're trying to evaluate and stress test these two key things. And before I move into how we run these stress tests, I would like to run the viewers through the S&P 500 chart for the past 100 years, right? So typically there are two strategies that are popular from an industry point of view. One is a value strategy and one is a growth strategy. Now, as a fund, we believe that growth is what we want to target and look for, and which has been very well demonstrated even by this S&P 500 chart. So in 1917, if you invested at the lowest PE multiple of 5 and you sold at the highest PE multiple in 1999, this was during the dot-com bubble, then even despite of such a large multiple expansion, in 80 to 83 years, you would have made an annualized CAGR only of 2%, which means that only 20% of the returns actually came from multiple expansion. So the popular strategy that we refer to, which is value investing, where try and buy at a low multiple, try and sell it when it comes to a higher multiple, in our mind, the empirical evidence shows that that contributes to not more than 20% of total return. In fact, 80% of all returns actually come from earnings growth, and which is nothing but companies being able to earn a high return on capital employed and reinvest it at a very high rate. So that is what we try and do. And so these are the 6 facets of our HexaShield investment process, the investment framework that we follow. And for a company to be defined as a company that passes the stress test, it has to pass all 6 facets of the framework. So, these 6 facets are reinvestment and growth, regulatory stress test, comparative pricing power stress test, governance and leadership stress test, cash flow stress test, and balance sheet stress test. So typically what we try and do here is we try and run a scenario analysis for each of these situations across industries and evaluate how our businesses will do. And the metrics that we look for is 25, 25, and 50, which is look at businesses with 25% return on capital employed, less than 25% volatility in the return on capital employed on a consistent year-on-year basis, and at least a 50% plus reinvestment rate. So we want our businesses to be able to reinvest 50% of the earnings that they make back into the business. So this is what we look for. And just by way of a couple of examples, if you again, please don't consider these examples as stock recommendations. They are just from an illustration and case study point of view. If you look at a business like TCS, 48% is the return on capital employed that TCS makes. Now, when we run it through our competitive and pricing power stress tests, typically the gross margin of TCS compresses. And even as the gross margin compresses, even at the 20th level of competitive stress test that we run, TCS still makes a 31% plus return on capital employed. Now, on the contrary, if you look at a business like Reliance Industries, where the return on capital employed is anywhere 10% odd, if you put it, and it's a price taker in some of the markets that it operates, whether it's oil and gas or retail, etc. And if you put it through a competitive stress test, in some scenarios, it actually goes to a negative return on capital employed. And in certain in the average typically comes out to be about 2% odd. Now, if our underlying business is going to make a 2% return on capital employed, we are not going to make a meaningfully different return. So the which is why Reliance actually fails the competitive pricing power stress test, and consequently also fails the overall stress test. The and if you are familiar with the price pattern, there have been years, 10-year periods where the stock has actually not given any returns, which is again demonstrated by the fact that low return on capital employed businesses can end up underperforming for long periods of time. So, in summary, I think for a business to pass, it has to pass all 6 facets. Now, we've run these stress tests on over 67,000 companies globally. And we've we've seen that only 125 companies actually pass these stress tests. So, there are 40 odd Indian companies, 85 odd global companies, which are a mix of American, European, Asia Pacific companies. And in the FlexiCap fund, that we will talk about in the next few slides, we are going to be investing in a 25 stock portfolio from these 125 names. So as a principle, as discipline of the fund investment process, we will not invest in any names outside this 125 stock universe. So that our investable universe to that extent is limited to these names. And obviously we use a lot of technology as a part of this entire HexaShield framework. So it is a completely tech-enabled process, and that allows us to underwrite risk across hundreds of scenarios across multiple industries. And the idea is that we married the power of human intelligence along with computing capability that algorithms and systems allow it, and we are doing this at scale. Otherwise, it would be practically impossible to run these stress tests and the scenario analysis for over 67,000 odd companies globally. Now, the other thing I think what we are trying to do is that we're trying to pioneer a new concept of active share in the active management industry. See, what is happening in the industry today is that almost, and this is a global phenomena really, that fund managers end up copying the index 70-80%, and once they copy the index, they charge a 2% fee. Now if you copy the index 70-80%, you'll get a similar performance to the index, and then subsequently when you charge a 2% fee, this is a construct that is designed to underperform really. So we intend to sort of bring innovation and transparency with active share disclosures. And our view is that when investors buy a mutual fund from Samco, not only will they get a fund that is truly stress tested, but they will also get a truly active fund which is measured by a high active share. So active share actually was a measure that was designed by 2 Yale professors, Kremers and Pedagitso. And in simple terms, what it means is that it measures how different is your portfolio from the index. Now, if your portfolio is not at all different, it's the same, then you are a passive fund for all practical purposes. And if your portfolio is completely different, then your active share is about 100%. And our intent is to operate in the segment of being an 80 to 100% active portfolio. And there are a couple of reasons for that. The first and foremost being that if an investor is paying an asset management fee to an active fund manager, it has to be for buying something that is widely different from the index. Otherwise, you can actually just pay a minimalistic fee on the index fund and go and buy an index fund if you're just buying a mere index hugging fund. Today, out of the 27, 28 funds in the FlexiCap category, a lot of funds have an active share of between 0 to 60%. So either they are passive or index huggers. So our intent is to be a truly differentiated fund and have an high active share. And there is a statistical mathematical reason as well as to why we intend to do this. So if you have a fund with a 90% active share, if 10% is just the overlap with the index and the index makes 8%, you make a 0.8% kind of a weighted return. The balance 90%, to get to a 10% gross return, you need to generate a 10.2% return. That's how your average will get to 10%. Now, this is the kind of fund that we intend to run. On the contrary, if you look at what the industry is running, they are running something like at the bottom of the table, where 70% you are mimicking the index, 8% if your is what your index return is. Then on the balance 30%, you actually need a 14.7% return, which is almost 6.7% more than the index return. Now, it's a lot easier to get 10.2% return vis-a-vis 14.7% return, which is what we intend to do. And when fund managers today, they have maintained a low active share, they actually end up taking a disproportionate amount of risk when they are looking at trying to generate a 14.7% kind of a return. So that's why we intend to operate, truly differentiated active share funds. Now, as far as the fund strategy is concerned, it's a simple three-step strategy. We will buy efficient companies at an efficient price and maintain an efficient churn. Now, and the goal of our fund, our goal is to be the fund that generates the highest risk-adjusted return. So our idea with the fund is that we don't want to take excessive risk. We want to make sure that we are generating the highest possible return that we can for each unit of risk. So the goal is to optimize on and be on the top of the Sharpe and the Sortino charts, and not just chase point-to-point returns by chasing investment fads, really. So the three-step strategy, step one is we will buy only efficient, stress-tested companies. So as I said earlier, we will invest from our universe of 125 companies. These investments will be made in a ratio of 65% Indian equities, 35% global equities. So these are going to be high growth businesses in the mix of 65 and 35. The reason why it's 65% is so that 65% is actually prescribed by the Indian Income Tax Act, that if a fund has minimum 65% Indian equity, it can be a equity taxation product with 1 year capital gains. And after 1 year, if somebody sells, it's a 10% kind of a capital gains tax. So we will be investing in 25 names, maybe 16, 17 Indian names, 8 to 9 global names. That's how the mix will be. And by definition, a company that is an efficient company is a company that makes a very high adjusted return on capital employed. So see, we recognize that the fact that there are a lot of new age businesses that need not necessarily just make investments through the balance sheet. They also make investments through the P&L. So we adjust the return on capital employed for R&D expenses, marketing and advertising expenses, and technology development costs, and derive what the true earning capability of a business is. And then we evaluate that while we select a company being as an efficient company. And to break it up, as I said, we're looking at high ROC businesses with 25% plus kind of return on capital employed, in which earn them in cash on an adjusted basis and sustainable. So we are not looking at businesses where 1 year the return on capital employed is 0, and another year it will be 25, and another year it will be 100. We are looking at companies that can consistently make that 24, 25 kind of a percent, and consistently compound, really. So if you look at our universe today, the businesses in our universe are far more efficient than in the benchmark. So the return on capital employed for the Nifty companies is about 10.39%, vis-a-vis for our universe is about 24.27%. So these are far more capital efficient businesses. The gross margin of our companies is a lot better. Working capital cycle is a lot better. So on every metric, they do a lot better. And what are the drivers of these businesses, right? So the drivers of these high sustainable returns are broadly categorized into these 7 odd aspects, and we'll just give you some examples of each of these aspects. Again, statutory disclaimer that please don't consider these as stock recommendations. We are just trying to explain the characteristics of efficient companies. So these are companies that make essential non-differable products and services. So take an example of a company like Novo Nordisk. Novo Nordisk is actually a Norwegian company listed in Copenhagen. It makes insulin pen for diabetic people. Now, its customers are diabetic people who can't defer their purchases, unlike in real estate or in automobiles, where customers can actually decide that there is an economic downturn, so let's defer our purchase by 6 months or a year. Consumers of Novo Nordisk can't do that, and because of that repeat and consistent repurchase by the customer, the Novo Nordisk enjoys a 60% plus return on capital employed. They reinvest 50% of their earnings back into the business. And it's been a great compounder for years. Facebook, obviously, we are all familiar with Facebook, and we are habituated to using one out of their 3 products on a daily basis. Either it could be Facebook, WhatsApp, or Instagram, and that habit of returning back and using the product is what helps Facebook have very high returns on capital. We are looking at businesses that are price setters, not price takers. So you're looking at businesses which typically are leaders in the industry, and therefore they can set the price of the products or services that they sell. Microsoft, Asian Paints, Crisil are some examples of such price setters. All their competition typically follows suit when it comes to price setting is concerned. Finally, we are looking at businesses with very large reinvestment opportunities. So, it's not merely enough that a company makes a high return on capital employed. You want it to grow. Otherwise, it will become like a bond And there are several large great businesses like an ITC or Colgate, where there is a high return on capital employed, but because these companies are not able to grow because of lack of reinvestment opportunities, the stock price typically typically flatten. So we're looking at businesses like an Nvidia and Intuit, which despite of being multi-billion-dollar businesses, are reinvesting back into the business. So Nvidia is a global AI chip computing company. Intuit is a global accounting software company. So these are some examples of companies with large reinvestment opportunities. And finally, we are looking at companies with very large intangible assets, right? So see, these intangible assets could be brands, patents, network effects, installed bases. So we have Alphabet, which is Google search, Costco, which is one of the world's largest wholesalers with a very large subscription base of customers. Now, these businesses which have large intangible assets, it is very difficult for competition to replicate their business and copy their business, and therefore, because of the competition's inability to copy these businesses can earn sustainably high returns on capital for long periods of time. So, see, what will not form a part of the portfolio? We will have no PSUs, no cyclicals, no capital intensive businesses. That will be a part of the portfolio. The reason being, so we don't intend to have these businesses because of a rule of something that we call as the rule of 50-80. So there's a 50% chance that businesses in these sectors or segments, typically the 50% chance that a stock will fall 80%, or an 80% chance that a stock will fall 50%. So we don't want that kind of volatility from an investor return point of view, and which is why we will exclude these kinds of businesses. So if you were to look at like something, a price pattern of Tata Motors or a Tata Steel over a long term period, we you would see 100 rupee price goes to 500, 500 goes back to 125, 125 goes to 250. So it's a yo-yo price pattern, and that's typically something that we are trying to avoid. Now, typically there are two kinds of businesses in the world and two strategies to make money. One is you invest in the biggest businesses in the world, which is what the Nifty offers you. It's a composition of the 50 largest businesses. The other is you invest only in the best businesses, which are capital efficient and in our view the stress tested businesses. So out of the Nifty 50 names, only 15 companies pass our stress test. 35 companies fail. This is a backtest performance. Obviously, backtested performance comes with its own constraints. But yeah, you'll see that these businesses have performed with incredible might vis-a-vis the biggest businesses. And it's important to understand that there's a huge difference between the biggest companies in the world, in the country and the world, and the best businesses. So businesses like a Reliance and L&T, SBI, Coal India, ONGC, NTPC, these are the biggest businesses in the segments that they operate, but they're not necessarily the best. Now, also, I think what is important is that we understand that these businesses perform with incredible consistency. So no strategy can perform all the times. So, but this strategy as a strategy performs almost 2/3 of the time, where these businesses have outperformed their peers by about 2/3 of the time. And when the outperformance has come, it's come by a larger margin. When the underperformance has come, it's come by a smaller margin. And that is what resulted in the net positive expectancy and in net monthly excess return. Now, so the step one of the strategy was we will try to buy only efficient businesses. Second step is obviously we'll try to buy them at an efficient price. So what we intend to do is we don't intend to buy businesses at silly looking prices or pay exorbitant premiums. Obviously, the businesses that we are investing in are a lot better, much better quality as compared to the benchmark. So we have to pay some premium for those businesses, but we want to make sure that we don't pay an exorbitant or a silly looking premium. So and over the long term, we are big fans of the Charlie Munger quote, which he says that over the long term, your stock price return is going to mirror your return on capital employed for the business, and it's actually a mathematical certainty. So the kind of fund that we intend to operate is like company A, where our businesses are 20-24% return on capital employed businesses, and even if you invest in such businesses at a high multiple and sell them at a lower multiple, because the underlying compounding is happening at 24-25%, the long term returns typically end up mirroring that number. It could be anywhere between 17-18-20%. The kind of returns that company B generates is what typically the Nifty looks like. So the Nifty is a 10% return on capital employed, as I said. Even if you buy it cheap and sell it expensive, still your underlying return is not going to be different from the return on capital employed over a 5, 10, 15, 20 year period. So your CAGR will be about 11, 12%. So our aim is to be in that category A, and the aim is to be in businesses which typically are in long-term secular trends. We don't invest. So this, which is often referred to as continuum. We are not interested in investing in businesses which generate point-to-point returns. So we have been, IDEX is a global veterinary pet product company, pharmaceutical company. Novo Nordisk we spoke about. So these are typically businesses that perform with incredible consistency. And how do we make sure that we don't pay an extremely high premium? We have a metric that we call the adjusted free cash flow yield, where we calculate the yield for shareholders and add back a lot of growth-led expenditures and evaluate what the free cash flow yield is for vis-a-vis the rest of the universe. In our case, the yield for the Nifty 500 is about 2.38%. Vis-a-vis for our universe is about 2.07%. So we are effectively playing an implied premium of 16-17%, which is actually quite cheap. We are happy to pay up to a 25-30% kind of a premium, because if you recall in the earlier slides we discussed, these businesses are far, far superior than the market, which is at 10% return on capital employed. Our businesses are at about 24%. And the third step of the strategy, see, I think what we are trying to do is that if we done step 1 and 2 well, where we bought the right efficient businesses, we bought them at an efficient price, then what we will do is that we will completely reduce the portfolio turnover, and in the process end up reducing on the dealing cost. So today, I think there is a big myth in the industry. So that TER is the only cost that an investor pays. The reality is that investors also incur, there is a hidden cost which is called as voluntary dealing cost. So every time that fund managers they incur a transaction for buying and selling, they end up paying costs like GST, brokerage, STT, and these are all costs that are over and above the TER. So we at Samco intend to set new transparency standards, where we will, along with disclosing active share, we are going to be the first AMC in the country that will disclose voluntary dealing costs, so that investors can measure the total cost of investment. And the aim is to reduce the portfolio turnover and therefore have low voluntary dealing costs. So see, if you understand, today in the Flexicap category, the total voluntary dealing cost is the average portfolio turnover is about 149%. So as a rule of thumb, for every 10% portfolio turnover, the voluntary dealing cost is about 0.1%. So in India, we don't know what the VDC is because it's not disclosed, but the global average is about 1.2%. So if you were to look at the industry, which typically runs like a fund A, where you have 1.7% voluntary TER plus a 1.2% kind of a voluntary dealing cost, 2.9% is the total cost that an investor incurs. We intend to run something like a fund B, where even if our TER is about 1.7, 1.8%, the voluntary dealing cost will be low at between 0.05 to 0.10% because of the low turnover, and the total cost will be about 1.85. And this difference between the 2.9 and 1.85%, that 1% odd difference, is also a big source of return from an investor point of view. So investors will end up saving this cost, and on a year-on-year basis, this 1% will start compounding in value and start becoming a big number. As far as the portfolio construction process is concerned, typically it's a 25 stock portfolio. See, unlike other funds, Flexicap funds, which run 50, 60 stock portfolios, we are going to have a strict 25 stock portfolio with 65% Indian equity, 35% global equity. As I said, it's going to be a growth strategy. We will be fully invested at all points of time. No derivatives, no hedging, no debt. So typically not have any exotic instruments really. It's a pure equity fund with an ability to generate long-term wealth and create long-term wealth from an investor point of view. See, the reason why we've selected a 25 stock portfolio is that it is good enough number to reduce risk. So we are big believers in Burton Malkiel's theory of diversification, where he says that it's a statistically proven model that the moment you have 25 stocks, your risk is actually minimalized from a market risk point of view. And when you keep adding stocks, you will not be able to reduce risk any further. So, but having a 25 stock portfolio allows you enough concentration to also be able to generate a certain alpha over the index. So in summary, the idea is to give exposure to 25 of the best businesses in India as well as the world. It's a 65-35 India global exposure growth strategy. And we very often say that it's important that Indian investors don't restrict themselves to investing merely in India as a geography, right? So and we give an example of TCS. 1 rupee invested in TCS, which is India's largest tech company 5 years ago, would have grown to about 2.5 odd rupees in 5 years. So $80 billion market cap became about $200 billion in market cap. On the contrary, same day, if you invested in Microsoft, 1 rupee invested in Microsoft actually grew to about 6 rupees. So $400 billion market cap became $2.4 trillion in market cap. So as an Indian investor, we are all familiar with Microsoft or a lot of other businesses. So we should be able to invest in these global businesses and benefit from these global trends. And mutual funds are obviously the most tax efficient, cost efficient way of participating in this story. And we intend to sort of offer that exposure to investors in the fund. As I said earlier, it will be a fund with a very, very high active share. Our active share will be 80-85%. We will disclose it on a daily basis, so investors are able to check that how we are differentiating ourselves. And it's going to be a pure equity fund. We've got a fairly simple weighting framework as well, where we will weight our stocks basis where we believe is the largest compounding opportunity. And it's a very strict exit criteria as well. So it's a well defined process from an exit criteria point of view, where we'll sell a business if it subsequently fails any stress test, or if we find a more compelling opportunity outside our 25 stock portfolio. Because we are not running cash in the portfolio, we will sell the weakest idea and make in space for the 26th idea that we find. If we hit a 10% ceiling that is prescribed by SEBI, we obviously will have to scale back exposure. And if we believe that there is an event where valuation becomes indefensible, in such an event, we will typically exit the stock. So also, one more thing that we are doing at an investor level is we are taking engagement to the next level. So we are going to be India's first AMC to publish consolidated look-through metrics. So the way that we think about Samco Flexicap Fund is that it's a stock in itself. It is a stock which has 25 subsidiaries, and just like Berkshire, which has 67 subsidiaries, they report quarterly earnings for those 67 businesses. By consolidating them, we will also do the same, and we will, along with the quarterly fact sheet, submit the look-through metrics to the investors. So as investors, you will get a deeper idea of how our underlying businesses are doing, what the sales growth looks like, what the returns look like, what the gross margins, cash conversion, etc. looks like. And so that you can practically monitor the underlying performance and get an understanding of the direction of the NAV and the stock prices itself. As far as the governance structure of the fund is concerned, I, in capacity of founder director, sit as the chair of the committee. We come with over 18 plus years of experience. Umesh Mehta, who is the CEO and CIO of Samco Asset Management, he comes with over 25 years of experience. He's a chartered accountant and an MBA. Nirali Bansali, she is the designated portfolio manager for the scheme. She comes with over 10 years of experience. She is an MBA finance and an engineer by qualification. And before us, she used to work for a US equity research firm called Aranka. And Dhaval Dhanani, again, who's a chartered accountant by qualification, comes with a rich experience over 6 to 7 years, and who will be responsible for the overseas investments of the portfolio. So as a team, we are a team with over 55, 60 plus years of experience collectively. And what we are also doing is that we've unveiled something called as the Unit Holders Handbook. So everything that we've discussed today in terms of the strategy, we've captured it in the investor handbook. So investors can actually go through this and get a deeper understanding of the strategy and how we run our stress test process, how we select stocks, how we exit. All of it is covered in the handbook. So please feel free to go through the same. And finally, I think just to recap, the 3 top reasons to invest in the Samco Flexicap Fund are going to be these. So, where we will be investing in 25 of the best businesses, most efficient, capital efficient, stress tested businesses. These businesses are generating above average return on capital employed and are very resilient. And have shown the tendency to outperform. We will be investing in very high growth names. So in the entire FlexiCap category, out of 24, so there are about, I think, 26, 27 odd funds that are in the category today. Samco Flexicap is the only fund with a 65-35 India global growth strategy. There is just one other fund which is 65 India, 35 global, but that other fund runs a value strategy, which is very different. And as I said earlier, growth accounts for almost 80% of the returns, as is demonstrated by the S&P 500 chart that I showed you earlier. And then finally, we are going to be a fund with with a very high active share, very truly differentiated with 80-85% difference in the composition from the index components. And by maintaining a low voluntary dealing cost, we will look to add to performance, and say that cost saving will also get added to investor returns, really. So I think that's where we are from an presentation point of view. I think, Karthik, if there are any questions, I'll be happy to take questions, and walk through and address queries, really.
Yeah, thanks, Jimeet. Really learned a lot, in fact, in terms of how the way a particular fund is looked at and the way stocks are looked at. I think two interesting takeaways would be the stress test, what you talk about, and then I'm really keen to read through the investor document, what you the link, what you gave towards the end. And the very interesting takeaway, the second takeaway is the VDC, the voluntary cost, what you'll be disclosing. Really looking forward to go through that information as well. In fact, along with the viewers' question, in fact, I myself have a couple of questions. I would probably add them as well. It's really interesting to know amongst the universe of stocks, based on the stress test, what you're going to put in, about 125 stocks gets qualified. Is that what you mentioned?
Correct. That's right.
So what would be the composition of large, mid, and small out of these 125, if you have an answer for that?
Yeah. Fair enough. So see, broadly, I think the composition is about 50 odd percent, 45, 50 odd percent are large caps, and 40-45% are mid caps, and about 5 to 10% of these businesses are small caps. So typically, it's across the universe, and I think even from a fund investment strategy point of view, we are going to be across the universe. So it will be a true to label flexi cap strategy where we are going to be market cap agnostic, and I think broadly we will have 40-45% exposure in large caps, 40-45% in mid caps, and about 5 to 10% in small caps. So that's how the company. And I think one important thing that we'd like to highlight here is that, see, we Indians are trained to think about large and mid and small basis the SEBI definition. Now, when you look at it from a global context, that actually gets distorted, right? Really, because what may be a large cap company from an Indian size point of view will actually be a mid or a small cap company in the US.
Or a micro cap.
Yeah, correct. So I think it's important to look at it from that context as well. So a $50 billion company in would be very big in India, but a mid cap or so in the US. So I think with that composition, we've got opportunities from these 125 pretty much across the board.
Okay. And the 25 stocks, broader range what you gave, is it combination of domestic, international put together, or 25 domestic?
No, it's 25. So in the fund, we will have 25 names in total. Of which 65% will be India, 35% will be global. So approximately 16, 17 Indian names, and 8 or 9 global names. So that will be the broad mix or the composition as far as the 25 stocks is concerned.
And the stress test, what you mentioned, you did explain at the beginning. From the investor point of view, you can just probably put it in very simple terms. What is that stress test, and why is it important from an investor point of view to understand this?
Yeah. See, basically, at the end of the day, why? First, I'll address the question of why. So, see, from an investor point of view, as I said earlier, there are two things that matter. First, a company has to survive to make money, which is what we try and do with our stress test, to see that if, let's say, multiple scenarios occur, if there is a recessionary environment, if there is a degrowth environment, if there is a cash crunch, liquidity crunch, interest rate end up going up. So across multiple scenarios, we want our companies to survive. So that is why we do these stress tests. So that's number one. And number two, as I said earlier, the only thing that matters over long-term investments is that can our business make a 20-25% plus return on capital employed? Now, and only if they maintain, if they're able to make this 20-25% plus, will they be able to compound capital and make money for us as shareholders. So again, what we are trying to do with these stress tests is check if there was a recession, if there was a liquidity crisis, if there was an interest rate environment when interest rates went up, or there was a cash crunch, or there was an environment where asset liability mismatches were to occur on balance sheets. Will across all these situations, can our business still make 20-25% or not? In fact, most businesses end up failing because in bad times they actually go to the dogs, in the sense that they end up being businesses that could end up generating negative return or zero to sub single digit returns. And those are the kinds of businesses that we don't want to invest in. And that is the whole reason why this whole the premise of stress testing is very important. This is the premise, and it's critical to run these stress tests. And in simple terms, if I were to explain it from a retail point of view, how do we run these stress tests is we imagine what are the scenarios that could happen, what are the high risk situations that exist in the economy, in the world, that could exist at a company level. Then we try and simulate those situations, that if these situations were to actually play out, if let's say India was to degrow by 5%, or the world was to degrow by 5%, or there was a currency crisis or such things that were to happen, what would happen to our company? What would be the resulting estimated return on capital employed? And then we try and see that in that situation or scenario, can it still be about 25%? So it is a probabilistic study that we are trying to do, that was kharab se kharab time, maybe can we make that minimum benchmark that we are seeking or not? And is the business resilient? So I think in simplest terms, this is what we try and do from while running our entire stress test
So
process.
can we say what if analysis, like multiple parameters of what if, then the outcome? Huh?
Correct. So what would happen if X happened? What would happen to the numbers? What would be the probability of each of these situations? And then in the final outcome that would come in, if you run this what if analysis, would it still make cut the would it make an above benchmark return that we are typically seeking, which is the 25% number that we talk about, that can across these what if scenarios also, can we make that 20-25% or not? That's what we're trying to do.
So, Jimeet, you definitely made a strong case for this FlexiCap fund here with the new way of looking at stock selection process and so on. So that means you're very categorically mentioning that this particular FlexiCap from Samco is going to be completely different from that of the peer group or the competition per se.
Correct.
And to pick up the point what you mentioned in the previous question, it does really help, especially in bad market conditions as well. So does it mean that the downside risk is relatively lower in this particular fund compared to other funds? Can we say that?
Yeah. So I think that is the objective. As I said earlier, the goal is to reduce the downside volatility, and to make sure that we generate the best risk-adjusted return. So typically, the businesses that we are investing in, they are far more resilient. And even if you see what happens when the markets go down, cyclical businesses, very highly levered businesses, debt businesses, low margin businesses, they get hammered. Typically we are avoiding these kinds of businesses. Our businesses don't have as much debt, they are high margin businesses. So in bad markets, yes, they are supposed to perform a lot better.
So then, does it mean that you're not going to be part of the so-called momentum stocks? You would be avoiding those momentum stocks as long as it's not falling in your 125 stocks framework? They're out of the stock selection parameter.
Yeah. So I think it's wrong to say that our businesses don't have momentum. In fact, our businesses have some of the best momentum. A lot of these businesses could be tech businesses that are play on digitization, lending businesses. Um, I think momentum has to seen from what time period are you looking at. We are
Right.
looking at businesses which have great long-term trends that we can play out, that have momentum and tailwinds that can play out over 5, 6, 8, 10 years. We are not looking at momentum names from a 2 to 3 month perspective, that okay, chalo, ye quarter this is a high momentum sector, let's invest in this. So, yeah, so we are not looking at those short term momentum. Yes, we are looking to capture long term trends and long term momentum of underlying businesses.
You did mention about VDC very clearly well, but again, from a viewer's point of view, can you throw some light on VDC and why is that important for an investor to be looked at?
Yeah. So see, what first of all, let's understand what is VDC. Voluntary dealing. Every time a fund manager makes a churn, okay, which is voluntary. See, there are only two instances of involuntary dealing that a fund manager makes. When one is when a purchase is made in a fund, and the second is when a redemption is made. Now, let's say an investor invests 1 lakh rupees in the fund, and the fund manager deploys that 1 lakh. It is involuntary. You have to invest it. And at
Yeah.
the same time, if you redeem, let's say 50,000, and the fund manager sells 50,000, then the fund manager has no choice. It's involuntary turnover. But
Yeah.
let's say in this period, once between the purchase and redemption, the fund manager keeps churning. He buys stock worth 50,000 rupees, sells 50,000, again buys 1 lakh, sells 1 lakh, buys 75,000, sells 75,000. What ends up happening is that every time this voluntary churn and voluntary turnover is made, there is a cost associated with it. You pay a brokerage cost, which is about 10 bip. You pay STT on buying and selling. You pay GST,
Yeah.
and typically all these costs are added to the cost of the fund. Now, please understand, these are not a part of the TER.
Yeah.
And every time you incur an excessive cost, your return is falling, right? It's the same argument with regular and direct, right? Where the whole
Yeah.
argument is that if you go direct, you end up saving 1%, and that 1% over a long period of time could be very, very large number. So it's important from an investor point of view because it is a cost that is eating away from return. And if you keep that cost low, then it is possible that that saving that you make over a long period of time could compound and become fairly large from a value point of view. So, and at the end of the day, it's important from an investor point of view because it's the investor's money, right? So it
Yeah.
is investor's money. It is important for you to know what is your total cost of investment.
Yeah.
Today, there is a misconception that only TER is the cost, but that's not the truth. You are actually paying a TER, which is the disclosed transparent cost, but you're also paying a VDC, which you don't know about. So,
Mm.
we're trying to sort of bring in more transparency to the industry with these VDC disclosures so investors can take a true call by getting a complete picture and not just a half picture, really.
Okay. Yeah, no, I think that's definitely a great perspective from an investor point of view to look at investing. So, from Indian context, you did show that example from a global market point of view. From Indian market point of view, since you've been in the broking business also, what is a ballpark VDC range for existing funds in India?
See, as I said earlier about the rule of thumb is that for every 10% portfolio turnover,
Hmm.
0.1% is the cost
Okay.
from a voluntary dealing. Now, the average category turnover in the FlexiCap category
Hmm.
across all the FlexiCap schemes is about 149% today. Now,
Yeah.
if you were to apply that straight rule of thumb, 149% into 0.10, you're looking at between
1
1.4
point.
to 1.5% in voluntary dealing cost. Now, we will not know the true number that unless everybody starts disclosing this.
Disclose.
But I think if the global averages were anything to go by, our broad understanding is that the global average for these voluntary dealing cost is about 1.2 odd percent. And I think India would be more or less in that range, give or take 10-20%.
So does it mean, one takeaway, the general takeaway could be that in the fund fact sheet data, when we are looking at, there is a ratio called as portfolio turnover ratio. Ideally, look at funds with lower turnover. Is that what you're saying? I mean, if we just were to take this learning and then implement it from a fund selection point of view?
Yes, I mean, obviously that is one of the factors for sure. I think
No, provided all other factors are satisfied and then you like the fund. If there are three or four funds, now probably one fund or two funds you could pick up would be the one with the lower portfolio turnover.
yes, probably.
Okay.
I
And
think just one caveat here is that see there is nothing wrong with a higher turnover. There is
yeah,
the only challenge is that the higher turnover has to justify and show up in performance. That
yeah,
is the important aspect. So if you are having a 200% kind of a turnover and you are incurring a 2% VDC, there is an important factor that you should be able to at least generate an alpha of whatever you are going to otherwise generate plus 2 plus something. So
yeah,
as long
correct.
as it So, and which is very hard to do. Really, the reality is that when you keep incurring expenses, that's a permanent loss of capital, really. And unless you are able to truly be like Jim Simmons, and even with a very high portfolio turnover, you're able to generate a very superior return. It doesn't really make sense to incur those many costs. So obviously, the ultimate prize is total return, and our humble submission is that costs are a part of what eat away from the total return. So look at it both together.
Both together. So you did mention this word in 3 E's, what you mentioned, the efficient churn. Um, uh, According to you, I mean, from the Samco fund point of view, what could be the churn rate here or the portfolio turnover rate? And this 125 stocks, what you mentioned, how regularly or frequently you're going to apply the stress test on that particular portfolio?
Got it. So see, as far as our churn is concerned, I think our sense and our broad guidance is that we will have a portfolio turnover of between 5 and 10% every year.
Yeah.
That's about it. So it means that out of the 25 names, at best, maybe 2 or 3 names in the whole year may get churned out. The rest,
Yeah.
more or less, the portfolio will be a buy and hold and a verify kind of a portfolio where we keep evaluating these names. And so I think that's the indicative range of churn that we look at. And I clearly sort of outlined the exit strategy as well. So we have a fairly strict exit discipline. So if at all that exit discipline is or those exit conditions are met, only then there would be any portfolio turnover or churn really from the portfolio standpoint. The second is as far as the frequency of the stress test is concerned. We run our stress tests at a frequency of every week, every month, quarter, biannual, and annual frequency. So idea is that if there is any new information that keeps coming in that gets accounted for, and we keep applying these stress tests and ensuring that we are not missing out on any new information that comes in, and consequently not missing out if a company is failing a stress test or not. Now, our generally, we have seen that the the manner in which these businesses, the universe changes, is about 4 or 5 stocks get added every year, or albeit 4 or 5 stocks get deleted every year. I mean, and those additions or deletions could be because of a variety of reasons. Could be corporate actions, delistings, acquisitions, or some new businesses getting listed or so. So broadly, I think that is the change in the as far as the mix of those 125 names is concerned. And typically our businesses are uh, businesses which have been very resilient. They have been around for the past 80, 90 years on a median basis out of these 125 names. So these are companies that have survived a variety of cycles, wars and global financial crisis, dot-com bubble, etc. So they are more resilient and very unlikely to have rapid changes in this universe.
So then again, to reiterate the point, what you mentioned, compared to the existing funds in the market in the FlexiCap, you're 65 international, 35, sorry, 65 domestic, 35 international, but the only fund in the growth strategy. Is that what you're saying?
Correct.
The other fund, what we have in the market, follows the value style.
Correct.
Sure. That's all with the questions, Jimeet. It was really nice interacting with you. We wish you all the very best and good luck with the fund what you're launching. I really hope there's a good amount of wealth being added to the investors in the coming years. Thank you.
Thank you so much, Karthik. Thank you so much for having me. And as you said, we are excited to create long-term wealth for investors with the fund and the strategy. So we look forward to doing some great work for years to come.
Thank you very much. Thanks for joining in. Thank you.